Hello, everyone. Welcome to another episode of Market Matters with me, Dr. Diffins. In today's episode, we're going to talk about how you can become an active participant in the stock market. And this video is actually going to be pretty quick. It's not exhaustive by any means, but investing in the stock market is something that I can tell you is fun, and it's definitely worth your while to explore. A lot of times people are intimidated by just the word stock market, but really it's not something that should be intimidating to you. Now, to get us started, we're going to talk about the why. This year, we've experienced the highest inflation, probably like in the last 40 years. And I just have a quick definition here, and it says inflation is the decline of purchasing power of a given currency over time. Okay? So when I pull up this chart here, this is the chart of inflation. So in 2022, up until this time, it was April or May of 2022, you see our inflation rate was 8.26. And what that means is that if you had a dollar, if you could go back to January of 2021, and you had a dollar bill, that dollar is now going to be worth 8.25% less today than it was a year ago. Okay, and as you can see from this historical chart, inflation is rarely this high. So you can see in the years past, yes, your dollar was losing purchasing power. And again, the way they calculate it, this is something you can look into. If you look at CPI or you just Google inflation, you can see what they include kind of in this basket to figure out the inflation rate. But you can see historically it's been, under 3%. And we have to go way back to 1990 to see a 6% inflation rate, and all the way back to 1981. So you're talking over 30 years ago to hit this 8% rate here. Okay. And you can see again that the rate has fluctuated over time, but we're definitely in a high inflation rate period. And what that means is that your money literally is eroding. So if you have money in the bank, as of now, you're literally losing a lot of money. It's one thing to lose 1 or 2% a year. It's another thing to lose 8 and 7% per year with no signs of stopping. So I want to start off that as in terms of why that now, probably more than ever, there's some motivation or might be motivation to really put your money to work. Now, another reason why is because when we look at investing in the stock market, again, that can be intimidating because a lot of times we think, well, we'd have to go to school to do it. And honestly, there's a lot of information out there on the internet that can help steer you in the right direction. And there's a lot of information, probably more out there, that'll steer you in the wrong direction. So I'm going to come to this simple calculator to help us understand. We're going to plug in some assumptions and see what investing can actually do for us. I'm going to go ahead and start with an example of $1,000. So you have $1,000 and you were to invest it. we're going to make the assumption of 6 years, and then we're going to go with a rate of return of 10%. Now, the reason I'm saying 10% is because that's the average rate of return of the stock market, generally speaking. That's going to be your S&P 500, I'm sure you've heard of, or if you've heard of the NASDAQ's a little bit higher. That's your average rate of return. I'm going to have it compounded annually, and then I'm going to do a contribution amount of $100. At the end of each month, we're going to do $100, and we're going to do that for 10 years. Now, when I plug that in the calculator, what you'll see is that we have our $1,000 original investment. We've made $9,000 in contributions in total, so we've put $12,000 in, and we see here that we would have an interest gain of $9,580. Okay, so I'm going to come down here to this chart where we see they have a little breakdown for us, where we see the green line is our balance overall, with the blue line representing the principal. So this represents what we've put in over that 10-year period of time. And then the blue line is representing the interest that's earned. And you can see that over time, here's on an annual schedule, you'll see that our balance is going to increase. Let's see what schedule. Yeah, this is a yearly schedule. Okay, so you see that at the start of, we started with $1,000. Our ending balance would be, make sure I have this right. Our ending balance for year would be about $2,300, and this would be the interest collected. Right, and that makes sense because we're going to put in $1,200 over the course of a year of 100 a month. So it'll be 2,200 that was invested, and we're going to add this interest to it. Okay, and actually, sorry, this was the number I was looking for. We'll do the same thing next year. We'll add another 1,200, and you can see the interest the following year would be this. And as you can see, every year the interest is actually going to be increasing, right? Because we're going to be earning more money on the money that we're putting in. Okay, and then you can see at the end, that's how we would end up with a principal in principle that we put in of 13,000, but you see our ending balance would be this amount right there. Okay, so I'm going to go back up here, and yep, there's that same number, the $22,580. So 1,000 we start with, 12,000 over the 10 years of $100 a month, or $1,200 a year. Okay, now if we change some of these assumptions, for example, if we had a rate of return of 12%, and this calculator, you may want to play with it. It's just calculator.net investment calculator, because this same calculator or formula can be used for any type of investment. If you're into real estate and you're trying to figure out rates of return, you'd calculate it a little bit differently, but it's a very similar thing. Long time ago, when bank CDs, certificates of deposits, paid a lot of money, you would use the same type of calculator, and you can adjust the starting amount, you could adjust your contributions, and you'll get obviously different results. Okay, so this is the why behind investing, and really what it comes down to is this rate of return. If we keep money in the bank, our rate of return would be close to probably less than 1%. So if we take those same assumptions, you see that over a 10-year period of time, keeping our money in the bank, we'd only make $716. So really what we have to do is we have to find ways to grow our money, and the stock market is just one of those means. Now, it is one quick thing before we go a little bit deeper into the how, is when we think back to this inflation rate, then you really start to think, okay, if I make a 10 or even 12% rate of return in an investment, I'm also having to take out the 8% inflation. So even if right now you made 10% in the stock market for the year, you'd have to take away the 8%, which again would leave you with a 2% gain. If you have that same money in the bank with a 1% rate of return, then obviously instead of having an 8% impact or erosion of your money, you would only have 7%. So you do slightly better off, but you're still losing a lot of money. Okay, so that's, again, the why. Moving into the how. And again, with these videos, you'll notice I don't have any links or endorsements or affiliates, at least not yet in the videos, comment or descriptions, because really it's just showing you, I'm just trying to share this knowledge, and hopefully it'll help somebody to reach maybe their financial freedom goals. This is an example of a trading brokerage, and this allows you to engage in self-directed trading. And what that means is that you, of course, could have a 403b as a teacher, or if you work for another company, you'd have 401k. You can invest in a variety of ways. However, if you wanted to do it on your own, TD Ameritrade is one of the, I'd say, better brokers. Before, if you were to make a trade, you had to call it in or you had to use a broker. And then over time, say about 10 years ago, these companies, these trading brokerages were charging like $10 per trade. So $10 to buy, $10 to sell. Then it went down to $5 because of competition. And now the bulk of them, they actually charge $0 in commissions. Okay, there's no fees, no data fees, zero minimums. So they've really gotten competitive, and I would say TD Ameritrade is user friendly. So it's why I would even suggest starting there. I'm sure you've heard of, if you follow anything with investing, you might have heard of Robinhood. There's Interactive Brokers. again, there's not a lack of brokerages that you can use, but TD Ameritrade's an example. So all you would have to do is you'd go up, you'd set up an account, and see, again, you'd come to open an account, and then you'd go through and create like an individual account, and you'd go through and you'd answer questions. If you're interested in opening up a retirement account, for example, a traditional IRA, they give you a nice breakdown here, but I'd encourage you to spend some time watching videos and possibly talking to your financial advisor to get more information. But just in summary, they give you an example here. So a traditional IRA, it's a retirement account. You don't pay any taxes on the earnings until you make withdrawals in the future, and you can contribute up to $6,000 a year, and then again it goes through some of like the required minimum distribution. So you'll have to make pull money out of it at the age of 72, and it looks like if you pull money before 59 and a half, there's going to be penalties for that. So that's the thing with the retirement accounts. You definitely are going to want to read to make sure that the money that you're putting in is money that you know you won't touch for that specific period. Again, the Roth IRA, this is actually something that a lot of people do not consider, but it actually could be a very lucrative and powerful tool for investing, because this one, you're funding it with after-tax dollar contributions. So that means whatever your paycheck is, that's your net amount of money that you make, and then you've already been taxed on it, and you could put it in these Roth IRAs. And then what will happen is when it comes time for you to pull the money out, you're not paying any taxes on that. And I can tell you, if you were to run a calculator and you do like a 40-year time frame, you can see that you probably would contribute maybe $150,000. And then when it comes time to 40 years from now, you'll be sitting on $1 million. And if your money is in the Roth IRA, you're not going to pay taxes when you pull money out of that $1 million. So again, something definitely to worth looking at, especially if you fall in these income ranges here. So as long as you make less than 129,000, if you're single or if you're doing a joint filing, as long as it's less than 204, you may qualify. Again, research it, but definitely a powerful tool. All right, so then back to the original, again, your individual account is a standard account. There's no tax advantage to it. You're going to be responsible for reporting any earnings, and those earnings may come in the form of dividends or may come in the form of capital gains. So if you purchase a stock and then you go and sell it, you're going to have to pay capital gains on it. And again, there's videos out there. This is just a quick run through it.